For Morningstar, I'm Jeremy Glazer. The Federal Reserve held rates steady at its September meeting. I'm here with Bob Johnson. He's our Director of Economic Analysis for his take on the release and also the press conference afterwards. Bob, thanks for joining me.
Great to be here today.
So there was a chance that the Fed was going to raise rates in September. They chose not to. What held them back? Why do they think the economy isn't quite ready yet?
Yeah. I think they were really clear on that the U.S. conditions were pretty good and as expected. Maybe they could be a little better in a couple of areas. But the key thing was the international developments. And there they made it very clear that they weren't trying to help the other world economies, but that they were fearful of what would happen to U.S. net exports if the rest of the world continued to slow, and especially China. And so I think that was the main thing that held them back was international activity. And again, it wasn't an act of altruism. It was something to protect our economy and our growth rate here in the U.S.
They mentioned that financial conditions were another thing that concerned them. Do they see that some of the volatility we've seen in the stock market as a problem, or is it the underlying issues with the global economy that they're more concerned about?
I think they're much more concerned about the global economy. They can't worry about the individual movements in the stocks and stock market volatility, but they are very concerned about the overall economic activity and what that might mean.
Along with these releases, we also see what the Fed thinks the path of future rate increases will look like. Any changes there? Any surprises?
Well, I think the key thing, you mentioned that at the beginning, they kept the Fed funds rate, which is the key thing they control, at that 0 to 0.25% range. And what they did was they said that they're keeping that, but they also indicate what each of the governors thinks going forward, not by name, but they do a little dot plot of where everybody thinks things are going to be. 13 of the 17 governors still believe that we'll have a rate increase sometime in 2015. So that's not all that far out. And so I think people still believe that it will happen. In a small nuance, there were even more that thought this was going to happen in 2015 at the last major meeting. So it did, slightly fewer felt that they would be raising rates, but it's still 13 out of 17 is a pretty hefty number.
And when you look out on their expectations for years to come, what do they think the path of rates is? How fast do they think they're going to have to raise when they start?
This has got to be one of the slowest trajectories that we've seen in some time. Usually within a couple of years, the rates go up 3.5%, sometimes even more than that in the Fed funds rate. And right now the trajectory is maybe 0.4% by the end of this year, implying one rate increase, 1.4% for the end of 2016, 2.6 by 2017. So a very slow and measured trajectory of interest rate increases is what's in there.
Looking at their other projections, what do they see happening in terms of growth in the U.S. economy? Yeah,
that was kind of a mixed bag there. They had kind of almost a silly number for 2015. They had previously had a 1.9% growth rate. They've raised that to 2.1% now. That's fourth quarter to fourth quarter GDP growth rate. I still think that is way too low, but in any case, they did move it back into that 2 to 2.5% range that we've been talking about for so long. And frankly, the out years are also going to be in that 2 to 2.5% range. Some of those numbers are slightly lower than they were before in terms of a growth rate. But again, they did raise it on the front end of the curve here in 2015. On the employment front, the unemployment rate at 5.1% is near the long term of where the Fed wants to be. Why do they still want to see further improvement in jobs? That came up a few times. Yeah.
What else is the committee looking for?
Yeah. I mean, they're pretty good with the jobs numbers in a general way, but they're kind of interested that the wages really haven't gone up, so that maybe this isn't the best metric in the world to use. And they said, they're also worried a little bit about the participation rate and the number of people that are in part-time jobs that would really rather have a full-time job but just can't find one. And so those things are all kind of in the back of the head on the labor market. I mean, again, they've kind of met the targets that they thought they'd need to kind of be moving rates back up. But there are a few little question marks on the edge. And, if the world economy was booming right now and inflation was headed way back up again, they'd be moving. This would not be enough to stop them, but inflation, especially the report yesterday, again was a little bit weak on the inflation front. They still believe it's all transitory, that it's mainly energy related, and maybe a little bit of a strong dollar. and that if that starts to fade, then we'll get back to our core inflation rate of kind of 2% or so. So they're not real worried about that either. So I think clearly the international situation's really got them a little bit on edge.
Should they be worried about that inflation number? They said in the medium term they want to get to that 2%. Do you see us getting there in the near future?
Yeah. I mean, they did a lot of talking around that. They said, well, we can't really wait till it gets all the way to 2% because that's going to be too late, but we can't be too preemptive and stop the economy in its tracks. So I think they're being a little coy with that. But I think they'd like inflation to be higher than the numbers we're seeing right now. But I think that they don't have to be a lot higher for them to necessarily start raising rates.
So only 2 meetings left in 2015 in October and December. What kind of data, what kind of confirmation could come out in that time period that you think would tip them into actually raising rates this year?
I mean, I think a really strong inflation report in one of those couple of months that was outside of energy would probably do part of the trick. A couple of really strong employment reports could also do it. So I think those are probably the major things. And obviously, if things start to stabilize overseas a little bit, that would certainly be a help. And, you know, it's interesting. I mean, I think Europe looks a little better now than it did a few months ago. I think the U.S. looks a little better than it did a few months ago, China aside. But the commodities-oriented economies, the Australias, Canadas, Brazils, the world are all hurting probably a little bit more than we thought. China's probably a little weaker than we thought. So there is a world economy issue out there, but it's not necessarily an all bad thing for the developed economy. So it's kind of a mixed bag there.
So do you see them increasing this year?
I think they will. I thought there was a 50-50 chance that they would even today, but I do think they have to get moving at some point, because they can't wait until inflation shows up and then have to raise rates 0.5%. And that would really kind of foil their whole plan to kind of do this gradual trajectory thing. And if the economy does soften at some point, you know, they need to be able to bring the rate back down to something. They can't really effectively go much below that zero bound. And so I really think they need to give themselves some flexibility and slowly move that rate up. 0.25% isn't going to hurt the economy. I mean, credit card rates 14, 15%. A quarter point isn't going to make a difference. Even in the mortgage market, I don't think 0.25% is going to be enough to hurt you. And certainly there's other things like cheap gas prices right now that are driving auto sales, which is also usually a key hurt from the numbers. But 0.25% just doesn't dent any of those.
So an increase in October and December, it's not going to make a big difference to the real economy.
It's not going to make a big difference to the real economy either way. And again, October's a little harder because the infrastructure of the meetings, there isn't a big press conference scheduled after that one. So it's a little bit harder to raise rates in October. But she said very clearly that if things got strong enough, they could still do it in October. But it feels kind of like December to me, that when they've got all the infrastructure in place, and 1 month doesn't hardly strike me as enough time for things to have changed. So we'll just have to see.
Bob, I appreciate your analysis today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.